Hey, good morning, options traders. Well, a good question that I get a lot from our new traders is why do options have delta? They say it seems like there's something funny going on here with the options market because if I buy shares of stock and the stock goes up a buck, obviously I make the full dollar. But I don't see that with my option. Sometimes I'm lucky to get 10 or 20 cents, maybe 50, 60 cents, but I rarely get dollar for dollar. So maybe I should avoid this whole options market because it seems like it's just really weird and really speculative. Well, there's a very good reason that options have a delta. And if you understand why they have a delta, it will help you to better understand what your current delta might be, and probably more important, how that delta is going to change with the stock price, volatility, and time. So let's dive in. Why do options have a delta? Well, to answer that, let's start with shares of stock as a little review. First, understand that stock also has a delta. It just doesn't have a changing delta like you see with the options. So here's what delta means and why stock always has a constant delta of 100. So if this is our profit and loss diagram for shares of stock, here's our various stock prices across the horizontal. Here are the various profits and losses. So let's say that we just bought shares of stock for 50. So at this moment, we have no profits and no losses. But if the stock price rises from 50 to 51, we just put $100 in our pocket, at least as an unrealized capital gain. $1 move in the stock equals $100 in our gain, and that's because 100 shares of stock has 100 deltas. That's all it's telling you. What if the stock price moves from 51 to 52? We've now moved to this portion of the blue line, and if we look left, we've put another $100 gain in our pockets. Every time the stock price rises $1, we add $100 to the gains. And of course, we get the same idea in reverse. If the stock falls from 50 to 49, well, we lose $100. If it falls from 49 to 48, we've now lost another $100. It's always dollar for dollar up and dollar for dollar down. So notice that your profit and loss diagram for shares of stock is a straight line. There's no curvature to it. It's always delta of 1. Or again, if we buy 100 shares, we would say that there are 100 deltas. But when you start trading options, that is no longer true, at least most of the time. So here's our $100 call at expiration. I've talked about the fact we always get a bend at our strike. So this is a way we can see it. This is a $100 call. But notice that we have a flat line here below our strike or equal to it. And above it, we start looking like shares of stock. We're on this straight angled line. So yeah, at expiration, an option's pretty easy. If the stock is equal to our strike or below, we've got delta 0. This line right here is flat. That means you shouldn't expect any changes in your options price when you're at expiration because this call option's out of the money. So if you've got the $100 call and the stock's at 85 and it moves to 86 with 1 second to the closing bell on expiration Friday, don't expect a single change in your options price. You've got no deltas. It's not going to respond at all. On the other hand, what if the stock is above the strike at expiration? Now you've got delta 1. And at this point, and only this point, are we going to see that our call option is going to have a delta 1. We've got to be in the money and at expiration. So once again, options are fairly easy to understand their deltas if you're talking about the expiration bell, but that's normally what we're not faced with. Normally, as options traders, we're dealing with options that have time on them. So while this might be your expiration curve for this $100 call, if there's 30 days till expiration, this is probably what it's going to look like. It's going to be curved. It's not this nice straight line that we got for shares of stock or for an in-the-money option at expiration. And that means that this slope or this angle, as we move across various stock prices, starts to change. the sensitivity of that option's price starts to change. That's the delta. And the reason for this, it all stems from the probability of this option being in the money at expiration. So to understand delta, understand that delta is a direct result of an option not being guaranteed to be in the money at expiration. That's the key right there. Just because your option might be in the money now doesn't mean it's guaranteed to be there. Or just because it might be out of the money now doesn't mean it's guaranteed to be out of the money. And because of that, well, we're not real sure how to value that next dollar change in the stock. But what we do know is that the greater the probability of this option being in the money at expiration, the greater the delta. And the lower the probability of this option being in the money at expiration, the lower the delta. So when we're talking about delta, what we're really saying is what is the next dollar of the stock's price change worth? Now that's a different question from saying what is the option worth. But once we know the value of this option, let's say that we just paid $5 for it. What delta is telling us is that if the stock moves up $1 right now, how much is that going to increase this option? Or if the stock drops $1 right now, how much is it going to decrease the value of this option? Well, once again, it shouldn't be dollar for dollar like it is for the stock, because we're not entirely sure that this option is going to be in or out of the money at expiration. So this gets back to how do we value something that we're not real certain? And I've talked about this concept in previous videos, but let's say we have to figure out how much this box is worth. And there's a maximum of $1 hiding in this box, but it's not guaranteed to be there. Well, if we feel that there's absolutely no chance of it being in there, we shouldn't pay a single thing for the box. If we feel that there's a 10% chance of that dollar being in there, we shouldn't pay $1 for it. We should only pay 10% of that value, or 10 cents. If there's a 50% chance, or at least a 50% belief that there's a dollar in here, then we shouldn't pay $1, we should pay 50 cents for the box. And only if we know, or at least strongly believe, that there is a 100% chance for this dollar to be in the box, that's the only time that we should pay the full dollar. Well, options are behaving exactly like this for exactly the same reasons. So once again, it's pretty easy to understand the concept of delta if you associate it with the probability of your option being in the money at expiration. Why? Because the only time you're guaranteed to receive money from an option is under two conditions. It has to be in the money, and second, we have to be at expiration. Once again, just because it's in the money right now doesn't mean it's guaranteed to be there. So it doesn't matter if that option's trading for 5 or 10 or 20, it's not guaranteed to be that value at expiration. So this is what the traders are all trying to figure out, or at least part of the problem is how likely is this option to finish in the money? Now, what makes it also challenging is that this probability is affected by not only the stock price, but by time and by volatility. So think about some conditions. Let's say that the stock is currently trading for 100 and we've got 30 days to expiration. And we look on our broker's platform and we see a $150 call trading for a penny. Well, now think about it. Should this option move dollar for dollar with the stock? If you think that it should, that would be way too good to be true. That means you could buy this option for a penny and it would behave just like a $100 stock. What a fabulous deal that would be for a buyer, which means it would be a horrific deal for the seller. Nobody's going to sell you that for a penny and be on the hook for dollar changes. Instead, the traders are going to look at this and go, you know what, with only 30 days to expiration, this $150 call doesn't really have much of a chance of being in the money. So therefore, we're not going to give it a lot of value, only a penny, but its delta is probably also going to be 0. And that means if our stock moves from 100 to 101, don't expect this option to jump to 2 cents or to 5 or 10 or to anything else. It's probably going to have a delta 0 and it's going to sit there dead in the water and not move. Why? Because nobody believes that it's going to be in the money at expiration, at least right now. Now, on the flip side, what if you have, let's say, a deep in the money $30 call trading for $70? This is a special condition called parity. It's just trading for cash and no extrinsic value. So this is stock. The markets are saying we're not willing to pay a single penny for the extrinsic value, but obviously we have to pay the $70 of intrinsic value. So the market is saying this one is so deep in the money relative to the time remaining that we're reasonably certain that this is going to be in the money at expiration. So yeah, let's treat it like shares of stock today. It's going to have a delta of 1. Well, now ask yourself, would it make sense if this only moved 10 cents on the dollar? No, this option's so deep in the money, the market says it's stock, and therefore it's going to be delta 1. So now hopefully it makes more sense why, prior to expiration, you get this curved line. It's just showing different probabilities of that option being in the money. But see, the answer is easy when you're at expiration. Now the market knows. I can see if this option's out of the money because the stock is below my strike, in which case, delta 0. If the stock is above my strike, it's now stock, it's delta 1. But see, that's not true prior to expiration. So that's why the market is confident that the option's either delta 0 or delta 1 at expiration, because the market can see if that option's in the money at expiration or out of the money at expiration. And those are the only times you're going to see delta 0 and delta 1. At any other point in time, you're going to have a delta somewhere between those numbers. So once you understand the concept of delta, it should now be a little easier to understand, at least intuitively, how your options price is going to change with changes in the stock's price, volatility, or time. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.